Good morning, everybody. Today's date 9:36 a.m. Pacific Standard Time, date 2/14/16. Happy Valentine's to all the girls out there and all the ladies out there. What we have right now is a weekly chart on put option on the S&P. When the S&P started, these contracts were $132. As of Friday, they're super deflated at $2. Now, having said that, I've already did the S&P 500 index, which is on the S&P 500. And why is our risk the very lowest risk? We already have a live update on this S&P, and we were up $35 off of the bottom on Friday's expiration. And this is a double bottom, and potentially on the monthly contract on the S&P 500, we're looking at this particular contract, which is a $1,900 call. And everybody that trades options, first of all, they don't know how to trade index options where the biggest money is made. They just don't. And number two, they've never ever seen a call chart or a put chart, but you, as the public, you want to go out there and trade options based on what? Tell me what you base it on. What is your thinking process? We already know what you think and what you do. People ride these contracts down. We're able to get in here for $2. We buy 5 contracts. Our total risk capital is only $1,000 for the upside in these contracts on the S&P 500 on the weekly expiration. Not only that, I am going to pull in the $1,900. And remember, these will expire on the monthly on Friday. Here's what you need to understand right now: 11,945 contracts were bought on the S&P, and that 2.5 range, there's $3. If we get a gap down on Tuesday morning, we're going to try to get hit on this contract at $1.25. Another bounce in the oversold condition in the S&P 500 index. What the S&P 500 index calls, that is a $1,900 strike price right before you now, is extremely wholesale. What the professionals like to do and the public loves to do, everybody wants to trade options based on what? You don't have anything to base it on. You don't have a call chart or a put chart. And this is the low at $2.05. So what we are going to be doing is that we're going to do the following. The S&P 500 started out in the first week of January, and we've gone down 230 points to these lows. 230 points the S&P is down from its beginning trade that happened in the first part of September of last year is where the bigger correction was. And now the January has come in and the S&P has been mutilated. How to trade S&P 500 index options, how to get the least amount of risk. Why is it that our turbo option trading platform and our turbooptionexchange.com, these are our prices, these are our entries, and we have our own proprietary exchange. I have a daily chart on the $1,900 S&P contract. You can see down here, right here was $2.05. These contracts are totally mutilated. They were up here, like I said, $132 in the first part of January on 1.5. S&P has dropped 230 points. It's not very often that you can get this kind of opportunity in the S&P call side of the market. The put side of the market, I'm just going to show everybody. Here's the opposite end. We were inflated. That's called inflated. That was a $1,900 put that paid big money in the beginning of the year. On the put side, Once again, it got inflated and it's come down, and it's still inflated. Now, this side can continue to come down. You heard what I said now, the $1,900 put, and now back to the daily chart on the $1,900 call. This is super deflated. Our risk entry is going to be wonderful. Our upside profits are just amazing as they will be. And once again, the people who try to trade options, we have our TurboOptionsExchange.com, TurboOptionTrading.com, and we're bringing all the new features with the new sites and everything that will power you. I just want you to know that our risk is very minimal. People, just the other day, these contracts right here, they were up there at $16.20. Right over here, they were as high as $34 on these contracts. So when the S&P was doing what? When the S&P was getting mutilated, say mutilated, and you did. And so here's a daily chart once again. And we will have Mr. Gary put these two charts together with these call options. This is the S&P, man. That was their pop. When we buy this contract, we're going to be able to get a good move. And it's basically going to be an intraday entry and exit in these contracts. They are a monthly and they trade different than the weekly premium. Here we have the S&P 500 $1,880 call that is on this daily option site that we have. You don't have it, and we were over here, which was back on February 1st. They were $16.80 a contract. 3 days ago, the high was $26.50 on this contract. The low that was done on 2/11 was $4.80, man. And this is the $1,800 call. Now, when you see that, this is minimal amount of risk to ever even think that you can trade the S&P 500 index options for this kind of money. And they really bought that contract up on the $1,880 call. And if you take a look down here in the volume, on Friday, 5,000 contracts traded. On Thursday, 4,800 contracts traded. The total open interest on that particular contract right now is right here. So let's go to the open interest. It's 8,125 contracts. The people that had 26,000 call contracts, look at what the day volume was here just this last Friday, 15,000. People were buying the 1875 call contract on the S&P 500. There is a fortune to be made. Here is the 1875 S&P 500 monthly option that expires. But what we would like to show you is these contracts 3 days ago were at $30. The low was $5.80 to trade the 1875 call option on the S&P. And that Friday's low was $9. If I buy 10 contracts, my cost is $9,000. But just listen, the S&P is oversold. This is why we're looking at the call contracts and how to make a damn fortune on the S&P 500 call options. The 1900, and I'm going to go to the 1885, which got marked down here. The volume was 471 contracts traded. But guess what they did? They marked that price down to $7.60. And this is an 1875 call that hit a low of $6.30. This is the call side where the public got killed. They were $64 a contract. People don't know when to sell, and they don't. And this is the actual price in these call contracts. that how we make our decision when they're deflated versus what? Let me show you what. This is the put side. It got up here to $70. I mean, over here in the beginning of the year that we featured for a lousy $16, they went on the put side. They went all the way up here to $90, $93. I call that exceptionally good. It got deflated. And then we went back up and we have inflated area. And we're finally on the put side here. That put side can come down a lot further than the call option is totally marked down for entry on that S&P 500. Learn how to trade S&P 500 as a market maker in the option pit on the S&P 500 index and come and take your free 5-day trial. Not only that, we would enjoy having you